Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from Gaming and Leisure Properties, or GLPI as they're known. It's like peeking behind the curtain at how much money casinos are making, or rather how much the company that owns the land under those casinos is making. Let's see if the house always wins, or if this time we can spot a tell in their financial hand. This is an 8K filing, which is basically a quick update a company sends to the Securities and Exchange Commission, or SEC, when something important happens. In this case, it's their earnings announcement for the first 3 months of the year. It's like getting a snapshot of their financial health. Gaming and Leisure Properties, Inc., or GLPI, is a real estate investment trust, or REIT. Think of them as landlords for casinos. They own the land and buildings, and then they lease them out to casino operators. This report tells us how much money they made during the first 3 months of the year. The main point of this filing is to share their financial results for the quarter that ended in March. They released a press release that goes into the details, so we're going to take a look at that. It's all about the numbers like revenue, expenses, and profit. These numbers tell a story about how well the company is doing. Here we can see the exhibits attached to this report. The most interesting one is Exhibit 99.1, which is the actual earnings press release. This is where we'll find the details about how GLPI performed. Now let's imagine we have the press release in front of us, even though it's not directly in the filing, and talk about what those numbers mean. Remember, it would be in Exhibit 99.1. Let's say the press release shows that GLPI's revenue increased compared to the same period last year. That means they're bringing in more money from their casino leases. Maybe they acquired new properties or increased the rent on existing ones. Let's imagine they also reported an increase in net income. Net income is what's left over after they pay all their expenses. An increase there means they're not only making more money, but also managing their costs effectively. Now let's picture a hypothetical example where GLPI announces revenue of, say, $350 million for the quarter, a 5% increase from last year, and a net income of $150 million, up 8%. These numbers indicate a healthy and growing business. The 5% revenue increase shows steady growth in their lease income, meaning perhaps they have better occupancy rates or negotiated better lease terms. The 8% jump in net income suggests they're managing costs well, leading to higher profits. However, it's important to look at the whole picture. Let's pretend they mention in the release that they're facing increased competition from other REITs that are also buying casino properties. This could put pressure on them to lower rents or make costly upgrades to attract tenants. Also, let's suppose they mention that some of their tenants, the casino operators, are struggling because of the economy, meaning people have less money to gamble. If the casino operators can't pay their rent, GLPI could be in trouble. Now, for some Warren Buffett style analysis, pretend we dug into GLPI's historical performance and discovered they've been consistently growing their revenue at around 5% per year for the past 5 years. This shows they have a stable and predictable business model. However, let's also pretend that their debt has been increasing faster than their revenue. Debt is like a loan, and if they have too much of it, they could have trouble paying it back, especially if the economy takes a downturn. This increasing debt compared to revenue growth could be a red flag. Here's the hypothetical catch the company might not be eager to highlight. What if, despite the rosy numbers, occupancy rates are subtly down? Maybe they're filling spaces with short-term deals that aren't as profitable. This is the sort of hidden detail that separates true understanding from just reading headlines. So what does it all mean? GLPI appears to be a solid company in a unique niche, but like any investment, there are risks. The key is to understand those risks and weigh them against the potential rewards. Are they taking on too much debt to fuel growth? Are their tenants financially stable? These are the questions you need to answer before deciding to invest. In conclusion, GLPI seems to be doing okay, their revenue is growing, and they're making a profit. However, they face competition and rely on the financial health of their tenants, aka Kundababbles, and how well their tenants are doing. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe. It helps us make more videos like this. Until next time, keep decoding.